You know what's interesting about election nights? Most people watch them as political theater, as wins and losses for their team. But I've spent 7 decades watching something different. I watch markets. I watch how capital reacts. I watch what businesses do the morning after votes are counted. And on November 4th, 2025, something significant happened. Democrats swept every major race across the country. Virginia flipped from red to blue. New Jersey delivered a landslide. A Democratic socialist won New York City. California voters approved a redistricting plan that could flip 5 House seats. And in Georgia, Democrats won utility board seats for the first time since 2006. Now, before you think this is about cheering for one side or the other, let me be clear. Markets don't care about your political preferences. They care about predictability, policy direction, and what it means for business. And what happened Tuesday night tells us something important about where we're heading economically and what it means for your investments. So let's break down exactly what happened, why markets are paying attention, and what comes next. Because whether you're Republican, Democrat, or independent, if you have money invested, if you run a business, if you care about your financial future, this matters. Here's the situation in one sentence. In the first major electoral test of Trump's second term, Democrats won gubernatorial races in Virginia and New Jersey by significant margins, elected a Democratic socialist as New York City mayor, approved California redistricting that could shift House control, and flipped previously Republican-held seats across multiple states. Think of elections like quarterly earnings reports for the political system. They tell you how the market, in this case voters, feels about current management. And Tuesday's results were effectively a vote of no confidence in the current direction. Let's start with Virginia. Democrat Abigail Spanberger defeated Republican Winsome Earl Sears to become Virginia's first female governor. But here's what matters from a market perspective. Spanberger ran explicitly against Trump's tariff policies and federal workforce reductions. Virginia has hundreds of thousands of federal employees and contractors. The ongoing government shutdown, now stretching into its second month, has devastated their finances. Spanberger's message was simple. Trump's trade wars and retaliatory tariffs are attacking Virginia's economy and people. That resonated. She won decisively. That's voters telling you trade policy is hurting, not helping. In New Jersey, Representative Mikey Sherrill won the governorship in a landslide. New Jersey's electricity rates increased 22% this year, the second highest increase among all states. Sherrill promised to freeze electricity rates and make it easier to add power generators. She won Latino voters by a 2-to-1 margin. In counties Trump had flipped in 2024, Sherrill expanded Democratic margins. Now here's the part that got Wall Street's attention. New York City elected Zohran Mamdani, a 34-year-old Democratic socialist who quoted Eugene Debs in his victory speech. Mamdani defeated former Governor Andrew Cuomo, toppling what he called a political dynasty. His platform includes freezing rent for 2 million rent-stabilized tenants, making buses free, and universal child care. A Democratic socialist running the financial capital of the world. That's not something markets take lightly. And California? Voters approved Proposition 50 with nearly 64% support. That allows Democratic Governor Gavin Newsom to temporarily bypass the Independent Redistricting Commission and redraw congressional maps before the 2026 midterms. The target, 5 Republican-held districts. This was a direct response to Texas's Republican redistricting that could gain the GOP 5 House seats. Across the board, Democrats won on a single message: affordability. Utility costs too high, rent too expensive, federal paychecks stopped by shutdown, trade wars raising prices. That message worked everywhere. Now, let me tell you what this actually means from an institutional and market perspective, because this is where it gets interesting. First, let's talk about policy direction. When Virginia voters rejected a candidate aligned with Trump's tariff policies in favor of someone explicitly running against them, that's the market sending a signal. Tariffs raise costs for businesses. They disrupt supply chains. They create uncertainty. And uncertainty is what markets hate most. I've always said that American business does best when there's predictability in policy. Doesn't matter if taxes are a bit higher or lower. What matters is knowing what the rules will be so you can plan. These election results suggest voters are rejecting the unpredictability of trade wars and government shutdowns. Second, the electricity and utility angle. In New Jersey, Virginia, and even Georgia, where Democrats flipped utility board seats, the message was consistent. Energy costs are too high. Now, from a business standpoint, that's significant. High electricity costs affect every business that operates physical locations. Manufacturers, data centers, warehouses, retail stores, everyone. But here's where it gets complicated. Those high electricity costs are partly driven by the AI data center boom. Tech companies building massive computing facilities to train artificial intelligence models. Those facilities consume enormous amounts of power. That drives up costs for everyone else. So you've got this tension. The AI build-out that's driven tech stocks higher is simultaneously driving electricity costs that hurt consumers and other businesses. Voters just said they're not happy about that. That matters for anyone investing in the AI infrastructure story. Third, the government shutdown effect. This is the longest shutdown in history, now over 60 days. Federal workers aren't getting paid, government contractors aren't getting paid, services are disrupted, and in Virginia, where hundreds of thousands of people depend on federal employment, either directly or indirectly, that devastated the economy. From a market perspective, prolonged shutdowns destroy economic value. They don't save money. They cost more in lost productivity, delayed contracts, and economic damage to regions dependent on federal spending. Virginia voters just demonstrated that very clearly. Fourth, the redistricting implications. California's Proposition 50 and Texas's earlier Republican redistricting are playing a high-stakes game with House control. If both states successfully gerrymander their maps, they essentially cancel each other out. But the uncertainty about which party controls the House after 2026 creates policy uncertainty for businesses trying to plan beyond next year. Markets prefer divided government in some ways because it prevents dramatic policy swings. But markets also hate uncertainty about which party controls what. This redistricting battle creates exactly that uncertainty. I want to spend some time on the New York City result because it's the most unusual and potentially most significant for markets. Zohran Mamdani is a 34-year-old state assemblyman who identifies as a democratic socialist. He won decisively against Andrew Cuomo, a well-known moderate Democrat, and Curtis Sliwa, the Republican. His victory speech quoted Eugene Debs. He promised to topple political dynasties and implement sweeping economic policies. Now here's what's interesting from a market perspective. New York City is the financial capital of the world. Wall Street is there. Major banks are headquartered there. Hedge funds, private equity firms, asset managers, they're all there. And voters just elected someone who explicitly campaigns against wealthy interests. Mamdani's platform includes rent freezes for 2 million tenants. That directly impacts real estate values and returns for property owners. Making buses free affects transportation economics. Universal child care requires significant new spending. All of these policies have market implications. But before Wall Street panics, let's think about this rationally. First, New York City mayors have limited power from a purely capitalist standpoint. A city where working people can afford to live is actually better for business than one where only the wealthy can survive. Henry Ford understood this when he paid his workers enough to buy the cars they built. You need customers who can afford your products. Third, Mamdani's victory came with majority support from voters under 45. Young people, the future economic engine of the city, voted decisively for his message. That tells you something about where demographic trends are heading. Now, does this mean I think rent freezes are good policy? No. They distort markets, discourage new construction, and create long-term housing shortages. But understanding why voters choose them is important. They choose them because market rate housing has become unaffordable. That's a signal about economic stress. Markets always tell the truth about politics because voters ultimately respond to their economic reality. When people can't afford to live in their city, despite working full-time, they vote for dramatic change. Wall Street might not like Mamdani's policies, but Wall Street also benefits from a functioning city with workers who can afford to show up. Let me zoom out to the broader pattern here, because it's crucial for understanding what's coming economically and politically. Every single Democratic victory on Tuesday centered on affordability. Spanberger in Virginia, lower housing costs, healthcare costs, energy costs. Sherrill in New Jersey, freeze electricity rates. Mamdani in New York, rent control, free transit. Georgia Utility Board, lower electricity rates. This is voters sending a very clear message. Things cost too much. Now, inflation is moderated. The headline CPI number is around 3%, but that doesn't capture how people experience the economy. Electricity rates up 22% in New Jersey. Rent consuming half of income in New York. Federal workers going 2 months without pay. Trade war tariffs raising prices on imported goods. These are real costs hitting real people. And here's what markets need to understand. When voters consistently prioritize affordability over everything else, policy will shift to address that. Whether those policies are economically sound or not becomes secondary to political necessity. I've watched this pattern before. In the 1970s, when inflation was the dominant concern, voters supported price controls, even though economists knew they'd create shortages. In the 2000s housing bubble, voters supported policies encouraging home ownership, even as it built unsustainable leverage into the system. When economic pain reaches a certain threshold, voters demand action. They don't necessarily demand smart action, just action. And politicians respond by doing something, anything, to show they're addressing the problem. That's what these election results are telling us. Voters have decided affordability is the crisis. Politicians who address it win. Politicians who ignore it lose. That's going to drive policy going forward, regardless of economic orthodoxy. From an investment standpoint, this matters because it tells you where regulatory and policy pressure will come. Utilities will face pressure to lower rates, which affects their profit margins and returns to shareholders. Real estate will face pressure on rents, affecting property values. Any business seen as contributing to high consumer costs will face scrutiny. But here's the other side. Businesses that successfully address affordability will benefit. Companies that figure out how to deliver products and services at lower price points while maintaining quality will gain market share. Innovation that reduces costs rather than just adding features becomes more valuable. This is similar to what happened in retail over the past 2 decades. Walmart succeeded by relentlessly focusing on low prices. Amazon succeeded by making shopping more efficient and cheaper. Dollar stores grew because they addressed real affordability needs. The companies that succeed over the next political cycle will be those that understand voters just voted for affordability. That means finding ways to deliver value at lower cost. That's always been good business, but it's about to become essential business. So let's talk specifically about what this means for your investments and business planning. First, the 2026 midterm setup. These election results shift expectations for House control. Democrats are clearly mobilized. They outperformed 2024 presidential margins significantly. If this pattern holds through 2026, Democrats could retake the House. A divided government with Democrats controlling the House would mean gridlock on major legislation. That's actually not bad for markets in some ways. Gridlock prevents dramatic policy changes, but it also prevents addressing problems, which can build pressure over time. Second, sector-specific impacts. Utilities face political pressure on rates. That affects companies like Consolidated Edison, Duke Energy, and others with significant exposure to states where Democrats won on utility cost platforms. Not saying sell these stocks, but understand regulatory risk increased. Real estate, particularly in New York, faces rent control risk. REITs with significant New York exposure might see pressure. Commercial real estate faces questions about what a socialist mayor means for business environment, though practically his powers are limited. Third, the trade policy signal. Virginia voters explicitly rejected Trump's tariff approach. If Republicans want to win swing states in 2026, they'll need to reconsider trade policy. That could mean tariff rollbacks or modifications. For companies exposed to international trade, that's potentially positive. Fourth, the government shutdown signal. Markets need to price in that extended shutdowns have real political costs. This reduces the likelihood of future prolonged shutdowns, which is positive for government contractors and regions dependent on federal spending. Fifth, the infrastructure and AI investment question. If Democrats gain power on an affordability platform, massive investments in AI data centers that drive up electricity costs become politically problematic. That doesn't stop the AI boom, but it might slow the infrastructure build-out or require companies to invest more in their own power generation. Sixth, the redistricting uncertainty. California and Texas playing redistricting games creates uncertainty about House control. Markets hate uncertainty. This will hang over the 2026 cycle until maps are finalized and their effects become clear. So what should you actually do with this information? If you're a business owner or executive, understand that affordability is now the dominant political theme. Look at your pricing strategy. Can you deliver value at lower price points? Can you demonstrate you're addressing customer cost concerns? Companies perceived as price gouging will face political and regulatory pressure. If you're an investor, don't overreact to political results, but understand the policy winds are shifting. Utilities with exposure to Democratic-controlled states face regulatory risk. Real estate in major cities faces rent control risk. But companies that successfully address affordability concerns will benefit. Consider defensive positioning in sectors facing political pressure. Look for opportunities in companies that compete on value and efficiency rather than premium pricing. The dollar store model, the Walmart model, the Costco model. These approaches become more relevant in an affordability-focused political environment. If you run a business dependent on federal spending, Tuesday's results suggest extended shutdowns carry real political costs. That's moderately positive for future stability, but don't count on it. Build cash reserves to weather potential future disruptions. If you're in real estate, especially in New York, understand political risk around rent control increased significantly. That doesn't mean exit the market, but price that risk into valuations. Look for opportunities in areas less exposed to rent control pressure. Most importantly, don't let political preferences cloud investment judgment. I've seen Republicans lose money betting against Democratic policies they disagreed with, and Democrats lose money betting against Republican policies they opposed. Markets don't care about your politics. They care about reality. The reality is voters just sent a clear message about affordability concerns. That will drive policy. Policy affects business environment. Plan accordingly. Let me zoom out to the bigger picture because this connects to themes I've talked about for decades. Markets always tell the truth about politics because ultimately politics responds to economic reality. When voters feel economically secure, they're more tolerant of risk and change. When voters feel economically stressed, they demand immediate action regardless of long-term consequences.
These election results are telling us voters feel stressed. The specifics, tariffs, electricity rates, rent costs, government shutdowns, are just symptoms. The underlying condition is that too many people feel the economy isn't working for them, despite headline numbers suggesting strength. That disconnect between headline economic data and lived experience is dangerous. It drives political instability. It drives policy swings. It creates unpredictability. And unpredictability is what markets hate most. I've always believed that capitalism works best with broad prosperity. When working people have disposable income, they buy products, start businesses, drive growth. When wealth concentrates too heavily at the top, you get political instability and policy swings that hurt business. These election results are warning signs that wealth concentration and cost of living pressures have reached a point where voters are willing to support dramatic policy changes. That's not good or bad, it's just reality. And smart investors prepare for reality, not for what they wish reality would be. The companies that will succeed over the next decade are those that figure out how to deliver value across income levels. Premium products for wealthy consumers will always exist, but the bulk of economic growth comes from serving mass markets. And mass markets right now are telling you they need affordability. We live in a time when political analysis often becomes tribal cheerleading. Democrats celebrate Democratic wins, Republicans mourn them, or vice versa. But that's not how I look at elections. I look at them as data points about economic health and policy direction. And Tuesday's elections are telling us several important things. First, voters are prioritizing affordability above almost everything else. That's going to drive policy regardless of which party controls what. Second, trade policies that raise consumer costs are politically toxic. Third, government shutdowns carry real political costs. Fourth, energy costs have become a central political issue. Fifth, major cities are experiencing such severe affordability crises that voters are willing to try dramatic solutions. None of this is about whether Democrats or Republicans are right. It's about what the market, the voter market, is telling us. And markets always tell the truth, eventually. The investors who succeed over the next political cycle will be those who understand these signals and position accordingly. Not based on hoping policies they disagree with will fail, but based on realistic assessment of where policy is heading and what that means for business. I've spent 7 decades in markets. I've seen Democrats win and Republicans win. I've seen liberal policies and conservative policies. And I've learned that arguing with the market is expensive. Better to understand what it's telling you and adjust. Tuesday's elections are telling us affordability concerns have reached critical mass. Voters want relief on cost, and they'll vote for whoever promises it most convincingly. That shapes the business environment for the next several years. Plan accordingly. Stay disciplined. Don't let political preferences override sound judgment. And remember, markets don't care about your politics. They care about reality. And reality is that voters just voted for change because they're feeling economic stress. If you found this analysis valuable, hit that like button and subscribe, because we're going to keep analyzing how political developments affect markets and your investments, not through a partisan lens, but through the lens of what actually matters for building wealth. Stay rational, stay prepared, and remember, in markets as in politics, the truth eventually emerges. And right now, voters are telling us the truth about their economic experience. Listen to what they're